Hi, everyone. This is Jason Burack of Wall Street for Main Street. Welcome back to another Wall Street for Main Street podcast. Today, John Manfreda and I are joined by another special guest. Our special guest today is Kel Kelly. Kel has spent over 15 years as a Wall Street trader, a corporate finance analyst, and a research director for a Fortune 500 management consulting firm. Results of his financial analysis have been presented on CNBC Europe and in the online editions of CNN, Forbes, Business Week, and the Wall Street Journal. He is also the author of The Case for Legalizing Capitalism. Kel, thank you for joining us here today.
Thank you. Nice to be here.
Kel, I just want to jump right in here with the interview questions here. We're seeing the Occupy Wall Street protesters, and their solution to the problems here is they're blaming these large Wall Street banks, and their solution is that, we need more regulation. But I don't think the government regulating everything would solve any of the things. I just think it would misallocate more resources. So can you talk about the Austrian perspective here?
Yes, I can. First, let me just state that in many ways I sympathize with the Wall Street protesters. I think that first, I think this country fails to protest very much about many things, and I like the spirit of protesting, and I think they're directionally correct in targeting banks for being the cause of or a large part of the cause of our current problems. The problem is, as you said, they identify deregulation as having caused the problem, and when in fact it was regulation of the banking system that caused the problem, specifically the regulation that gives banks the power to create their own money, that allows them to control the very rate of interest of money and the quantity of money, the thing that connects every little thing in the economy, money. They control the price and quantity. That must necessarily cause problems. So the deregulation they cite that led specifically to derivatives going bad is not the problem. It's the money that was created that caused housing prices to boom and then bust, which could not otherwise have happened without that regulation allowing them to print money, and therefore you could not have derivatives, which are just that, a derivative of something underlying, in this case mortgages. You could not have the mortgages, and therefore the derivatives go bad. So in sum, we couldn't have had a problem without the regulation.
Yeah, and I think that's a really good point, Kel. But the counter that a lot of these protesters have, and that some of the other progressives, even the ones that have worked on Wall Street, will say was that Glass-Steagall was repealed. But I think the best regulation for the market would have been saying to these Wall Street, the CEOs of the Wall Street banks, that don't use fractional reserve banking. Don't speculate with your depositors' capital here. If you're a large bank and the majority of your banking is commercial bank, don't go speculate on crazy derivatives with your capital here and expect a bailout. The best thing that could have been done would have been the government saying there is no bailout. Don't make investments like this. Run your company prudently.
Well, right, but the government would never say that to them because the government actually says, hey, no problem. We don't consider that there's anything wrong with taking someone's deposits and loaning it to someone else while telling the depositor that their money is in fact still there and available. They encourage that, and court cases have determined that it's a completely fine thing to do. But the Wall Street protesters don't, or no one realizes that, this little problem we have now has been happening for 300 years in this country and then in every single other country around the world that has the fractional reserve banking system. So I think the problem is really a lack of understanding and knowledge by the general voting public and those who would protest as to what really is the true cause of our current negative effects.
Oh, those are some really good insights about, the regulation and the banking money and everything, and I agree with them. And I was actually wondering also, what I found very interesting was you were telling us before the interview the different views of Wall Street that people look at Wall Street as just one person or one view, but you were telling us how there's many different various views of Wall Street, and I was wondering if you could share that with our audience.
Yes, well, just to quickly summarize, what I had said was that just as in individual corporations, because we could also talk about the evil corporations, well, if you get inside of them and work in them, or if you meet the different people on Wall Street, which doesn't just mean literally on Wall Street in New York City, it means really around the world working in investment firms, those people are, usually very nice, down-to-earth people who have very wide, different-ranging views. Some are actually quite libertarian, free market-oriented. I've met many of them, but they, say, well, since this is the system, kind of as I do, since this is the system and no one's agreeing with me that we should stop it, well, I've got to jump on board and make money from the system. Stock prices could never rise if we didn't have the system. Since we have the system, I'm facing inflation. I need to jump on board this asset market inflation and make money off of it. So that's what they do. But then you have other people who kind of don't even think about it and just think about, well, no, I don't know about all that political economic stuff. I'm just a banker. I loan money. I help companies get financing. So they don't even have any kind of view. Then you have other people that would say, you've got the Keynesians who say, well, all right, fundamentally, technically, yes, those effects can happen, but the problem is we've just not managed it well the way we should, and we need to create money. We need to create loans for businesses. The economy can't run without, more money and capital. Or they say, yeah, but if we quit printing money and if we quit inflating, then we'd have deflation. And then your bank account wouldn't exist. Is that what you really want? Of course, they don't understand that, well, if you didn't print to begin with, there's no need for printing. There's no need for fractional reserve banking. It doesn't help anyone except people who control the process. The economy doesn't need it to grow, and it actually hurts it in trying to grow. So if you'll quit printing money, we would finally quit having these problems. And really, like a friend of mine who I was just discussing that topic with last week, kind of understands and knows that, but thinks we still kind of need it for social programs and so forth. So the point is there is a wide-ranging view on Wall Street. I think very few of them, honestly, understand that what they're really doing. As Murray Rothbard said, very few bankers understand money. I think few of them understand what they're doing and are aware that they're doing it and the problems they're causing. I think the economists do, but they have their moral, social reasons why they justify it.
Yeah, and, as being an Austrian School Economist like we are, there's beneficial deflation. There's, the free market through competition. It creates, higher quality goods and services at lower prices, and that causes the people's real savings, real capital formation, that causes purchasing power increases in their money, and that, creates a positive feedback loop, as I'd like to call it, for people to continue to produce and to, save.
Yes, but that's true. But let's be clear with the definitions. There is a difference between falling prices, which is what used to occur before central banking, and what would occur year after year with a constant amount of money. Prices would just kind of fall every year naturally because of increased supply. That is different from a deflation, which should be thought of as a monetary contraction, where the pyramided money based on the fractional reserves does the opposite of what it's been doing and collapses and causes as I say, a debt deflation. That pretty much hurts everyone, especially those who have debts to pay, whereas in increasing the amount of goods and services and lowering prices year after year, it doesn't hurt debtors. There's a big difference. So, but we could prevent deflation, a collapse of the money supply, essentially tomorrow by well, I don't want to get too technical, but there's a process that can be done where we just kind of take away all the pyramided money, leaving the real money, and all prices would fall to a fraction of what they are, but debts and assets and equity and prices and wages would all fall simultaneously equally, that could solve the whole problem. But they don't want to solve the problem.
Yeah, and that would create a long-term fundamental recovery. But like you said, the pain would just be too great because our whole society is built around debt at the consumer level, debt the federal government is taking on, debt the states are taking on, and debts from pretty much a lot of these major corporations, which they actually benefit from this system because they have a lot of assets and they can borrow very cheaply.
Yes, the financial system definitely benefits. Well, of course, until things go bad, but then they benefit because they have the system to bail them out. But yes, the way the system's been, everyone's used to debt now. But if we didn't keep printing money, or if we took out all the fractional reserve system, people first could not keep piling on debt the way they are, and they would get used to not having to, and we would return to a system where debt is not that prevalent. It can be done. It's just that there's no political will, and I don't think there will be.
That is very true about the deflation and the economy. I actually just want to switch topics for a bit and talk about subsidies and misallocation of resources. If you look at the industries, especially wind or solar, they're heavily subsidized. I was wondering what type of misallocation does that cause? And where do you see other industries being subsidized other than solar or wind?
Well, first, in terms of what misallocations does wind and solar cause, I would have to think about that. Well, first, the capital that's used to fund them, A, is not getting a positive return on the investment. And it depends how you define that. But the point is, to the extent that those are not profit-making still, they're consuming capital, they're destroying it, but the capital that's used to fund those entities is taken away from other parts of the economy. So what would be wealth producers are not getting the funding they need or the capital they need. Of course, ultimately, if this venture ceases and we decide, well, it's just not worth it and unprofitable, then not using it anymore and having to find alternative means, we'll find that capital has been destroyed, is my point, just like the housing bust. There's a boom, then a bust, and then you can't reuse a lot of the capital you've created. For example, in Illinois, there are hundreds of square miles of windmills. I was surprised to see when I first saw them last summer. Tons of big, tall, heavy white windmills. Well, if they quit using those, what else can you use a big white windmill for? Nothing. It's there. It'll just sit there and rust or be dismantled. So that's capital that can no longer be transferred to any other part of the economy. It's not a factory that can be converted from making solar panels to whatever else. It's just absolutely destroyed and wasted capital. And then other industries, legitimate industries, that could use the capital that those industries, the solar and wind industries, are using, they're not getting as much capital. So, for example, the oil industry, which is increasing technologically just at incredible rates, and they are producing more and more oil and lowering the real price of oil, and we could have even more oil and even lower prices, except that additional capital that could be used for new oil platforms or for digging deep in the Midwest and doing more high-tech, expensive horizontal drilling. Well, that's not done because the capital is instead used for solar and wind. So the net effect is reduction of capital, reduction of supply of goods and services, and higher prices.
Oh, that's an excellent point, and I was actually just thinking during your what you just told me is to back you up a little bit is if you looked at the emergence of the Bakken, the Marcellus Shale, and a lot of these new discoveries we've made, as in 2008, if we didn't misallocate some of our capital and resources towards, energies that aren't economical, imagine how greater these emergences could have been. And I actually was wondering if you were talking about capital being destroyed and everything. If you look at gas and oil and gas and what you pay at the pump, the government's extracting a lot of revenue. And I thought that was just, part of it could be because we're misallocating it towards other uneconomical. And if we didn't have those, uneconomical panels and everything, we wouldn't need those taxes you pay at the pump, and we could have cheaper oil prices. Do you think this theory could be a possibility?
Well, yeah, sure. I mean, it's literally money being taken away from those trying to buy gas or oil to instead fund something else. But here's the big thing about that. Most of the money taken from you in taxes, whether it's a tax on gasoline at the pump or whether it's highway taxes or property taxes or income taxes or whatever the myriad taxes we have are, most of it is just used to give to other people to spend with. In other words, it's not even an attempt to turn it into profitable capital. You're not even subsidizing something so that it can produce something else. You're just giving it away to people to consume on existing goods, which further depletes the existing goods. So, and further depletes the amount of capital we have with which to produce. So, yeah, that's the whole problem. To your point, if we didn't regulate, subsidize, and tax, there would be so much more capacity to produce so many more things, and we would have whatever we have now. We would have so much more of it at lower prices, and we would probably have so many more new and additional things that make our life better or more enjoyable or cause us to work fewer hours. We would have a much higher standard of living, but we don't because all of these resources are being wasted.
Kel, I completely agree with you. I think the government is definitely benefiting from higher oil prices because if you look at the budgets of the federal level and at the state level and some of these other people that are taking, their little cut on the gasoline price at the pump, the amount of the taxes is not dropping when the oil price drops. So this is creating, like you said, a negative feedback loop, I guess would be the right term, whereas we want a positive feedback loop to, get producers to produce more so it benefits consumers and prices come down.
Yeah, but here's the funny thing that, I just mentioned we're producing all this extra oil and gas now, which we are, especially in the U.S. If you look at U.S. oil prices, look at West Texas Intermediate, the price of that, which is always equal to Brent, is now, until last week, $20 difference in price, which is huge. That's because of the additional oil that's being produced in Canada and in the Midwest that's flowing into Cushing, Oklahoma. They've got such an excess supply there. They don't have the capacity to store it. They don't have the refiners to refine it. They don't have the logistics to ship it out of there. That shows you how much more oil and gas we're producing. But my real point was the price doesn't come down because we talked about printing money a while ago. That raises not only consumer prices, it also raises the price of every single thing that exists. Money that's created flows disproportionately into asset markets versus the real economy. So that's why we have booming stock markets, bond markets, commodities markets, and oil prices. So oil is simply inflation. It's showing how much money the governments print because money is flowing into oil prices when really it should just be falling year after year because we're producing so much more of it. So and most people have no idea of what's causing that. They'll blame regulation or evil corporations and so forth for all this high oil price that the government itself is causing.
Yeah, those are amazing points, Kel. And from an Austrian perspective, and that's how I look at the markets too. I'm a professional investor, and we do these podcasts pretty often. I interview other experts, and I want to get your views here. If you think from an Austrian perspective, if politicians and central bankers are making a lot of the same mistakes from the 1920s and 1930s, and we're seeing like the same mistakes now that happened 70 years ago.
Sorry, I didn't catch the last part. The same what as 7 years ago?
Are politicians and central bankers making the same mistakes of the 1920s and 1930s, like tariffs, capital controls, currency wars, resource wars, competitive currency devaluations? A lot of those things happened, in the 20s and 30s, and the U.S. was not in the same role in the global economy it is now, but I was wondering if you could comment on that from an Austrian perspective.
Yeah, I see. Yes and no, I would say. I often think to myself that if you study the Great Depression, and I write about it kind of in detail in my book, if you look at all the things that were done from a monetary perspective to a trade perspective to taxes, which, by the way, more than doubled, and then the sheer Gestapo-like control of industry, pure fascist control of industry that they put in, I often think to myself, boy, we think we're bad today. We're in much better shape than we were several generations ago. So I think in the 30s, they were actually much worse and much scarier people than we have today. I mean, granted, we have higher tax rates, but, they went from something like a 3 to 4% average tax rate to 8 or 9. And that's huge and dramatic. And they had massive deflation. Prices were falling, but they stepped in a Gestapo-like fashion and prevented companies from paying employees lower wages. So they kept wages artificially high, which made employees too expensive to hire, and so there was 25% unemployment. Officially, in real terms, it was probably higher then, even though they didn't manipulate the statistics as much as we do now. Still, it's a much higher unemployment rate than we have now. So I think things were actually much worse then, but they are similar in that we are pumping money to try to pump things back up, and that keeps the current distortions distorted, the misallocated capital misallocated. And we're doing in many ways the effect of keeping prices artificially high. We're not letting the housing market fall and collapse the way it needs to. We keep trying to subsidize that to some degree and pumping it up and overriding contracts. If we would just let everything go and let it collapse as it did in 1921, the Great Depression you've never heard about, because the government did absolutely nothing. There was a huge collapse, and it worked itself out in about a year's time. If we would only allow that instead of doing the things we did during the Great Depression, we would be certainly out of this current situation by now and on our road to real, true economic growth with much higher employment.
Kel, I have a follow-up question real quick. Why do you think politicians and central bankers are so adamant then about the interventionist policies, even though, honestly, a lot of these guys are going to know deep down that the stuff is not going to work? Why do you think they're so adamant about the interventionist policies then?
Well, I have interacted with many Keynesian economists, and my feeling on this, well, first, the politicians don't know. All they know is what their advisors tell them. Very few politicians do any research and study anything. Bob Dole did. He thought he was knowledgeable to some degree. But the point is, most politicians don't know anything. They turn to their advisor, economist, and say, what do I do? So first, if nothing else, the incentive, what the advisor economist will come up with is, hey, dude, if you want to just pump things up right now because your career is on the line, you only have a few years in office, then here's what you do to pump things up. You lower tax rates, you pump a lot of money in, and it'll really get the economy pumped back up again. Now, whether they know what's really going on or not, that's what they'll advise. Now, but even those who know what's really going on and the distortions and mislocations that can cause, first I would say very few of them do. they haven't read about crazy Austrianism, or they think the classical economics were all screwy because they did screw up on a couple of things, but they haven't learned that school of thought, and they really think that what you do is there's a lack of aggregate demand, there's not spending, we must spend. There really is a multiplier effect, they think, and the money and spending will be multiplied, and we can pump things back up. We always have, and that's just how you do it. So I think there are very few people who really understand and think about or have researched, what's really going on, what the real dislocations are, and they don't think about the production side. They don't understand there's not really a multiplier. They just think about spending and respending and pumping up this indicator called GDP, and I think that's really the only world they think in. And when they do hear Austrians saying something to the alternative, not only do they think that's just some crazy ideology that doesn't have the morals to care about people and want to help people, because what I got to give these people is they really do think they're helping and caring about people. But they think that our views are crazy, they won't work, and they don't even take the time to listen or investigate. And if no other reason, the final answer is because everyone thinks that way, all the mainstreamers think that way, and if they think differently, they're going to be looked at as quacks and dismissed from their peers, and they won't get jobs. So all of those reasons.
And plus the Fed is subsidizing their research. The Fed is, with that documentary Inside Job, the Fed is giving them money too. Absolutely.
Or the government. I mean, all those academic economists are, yeah, that's right. They're subsidized with their research, and their research better come out saying particular things. And they have a complete hold on the entire political and educational system. So, really, they can't lose, even though in economic reality they're really losing year after year, but no one realizes that.
Yeah, that's very true also, and I actually just wanted to say something. You made a good point. They actually think that because of the Austrian perspective, we don't want things to help out the poor. But in reality, it's not that we don't want the poor and downtrodden to get helped out. We just think it's better served through private charities, and we think the government would take from one, give to themselves, and then give some of it. And with charity, people forget. Some people just need a good kick in the butt, and others actually need help. But if you don't have the government, you have private organizations doing it. The private organizations will give the people who need a kick in the butt, and the people who need charity. But I actually wanted to transition to something. Your most recent article about the housing bubble and the interventionism that they use. I was wondering, will this, what will this do to the unemployment? Because you see a lot of construction employment in China to build these houses to nowhere. And I was also wondering about your reaction. How do you think this will affect the U.S. consumer? Because they do buy treasuries trying to prop up our purchasing power to buy their goods. Do you think when this housing bubble in China bursts that they'll stop that, or will they print more money like they did in 2008?
Well, first, as far as the unemployment in China from a collapse in their housing market, which surely is on the way, well, I would think that they couldn't help but to have significantly higher unemployment unless they start subsidizing and paying to keep people producing houses, even though there's no market demand for it, because this is a communist country, and they have, after all, built entire cities of empty hotels, and in fact, entire cities that no one lives in. Entire cities, entire shopping malls that no one shops in, no stores are rented, no one lives in. So, if they're paying and subsidizing for all this kind of stuff, if there's a housing bust, you might have 0% change in unemployment because they will just keep spending for all of those people to remain unemployed, where at least here market signals tell people to quit doing that, and companies lay people off. Now, as far as the dollar purchases, from an economic bust in China, let's see. I'm not sure, really. I think it depends. Well, you've got the trade surplus, and you've got the dollar reserves being bought. Well, the dollar reserves are being bought because of the trade surplus. The trade surplus exists because the currency prices are not what they should be, and that creates an incentive that creates a situation where goods are artificially exported from China and imported to the U.S., and so therefore dollars flow into China. So the question is, what will affect the Chinese exchange rate that's being held artificially low? And first, I know their policy is to actually raise the exchange rate, and as they print more and more money, their exchange rate will be less undervalued in terms of relative purchasing power parity. In fact, I have heard arguments on CNBC, and I've not researched it myself, I've not thought through it, but I've heard arguments that because of the rising prices they have, their currency is actually already at parity, if not above parity, and they're not even artificially holding it down anymore. Of course, I think they must be if their reserves are continuing to increase. But so if there is an economic bust there, that's caused by not printing money at as high of a rate. Their money supply growth is slow. Their interest rates are rising. So if anything, that would cause let's see. I've got to think about that. If they're printing less money, their prices will not continue rising as much. Well, I could see different ways it could go either way. So I'm not sure I'd like to provide a concrete answer. But the key is how much money they're printing, how artificially undervalued their currency is, and what relative prices are between the two countries.
Yeah, and I think the reason, Kel, you're kind of seeing both sides of the argument here is we're in unprecedented territory in terms of, the interventionist policies globally and how the entire world is on a paper fiat currency system is, this is all one big experiment here. We've never really had this type of experiment on a global scale before, have we?
Well, no, we haven't, but and that is, I think, a more important topic. But I do think we can look at what I was saying about China kind of in an isolated way in terms of what China specifically is doing and what the effects of that will be in terms of its inflation rate and its manipulation of its currency and what the currency value and relative prices will be. So I think I'd really have to think through the likely scenarios and whether that would result in a higher or lower currency and higher or lower relative prices.
Now, do you think that China, from a fundamental economic standpoint, housing bubble aside, because China does have a very strong manufacturing base and the rest of the world pretty much is very dependent on Chinese manufactured goods. So do you think China is in a better fundamental standpoint for their economy longer term than the U.S. and Western Europe are?
Well, that's an excellent question. And first, I don't know that manufacturing or services as a larger proportion of the economy makes that much of a difference. You can produce and export and exchange either of those. But I would think, well, it's interesting. My overall thought, the overall answer is, I think China must necessarily be in a much better shape than the U.S., because of the fact that though they're communist, their markets are free enough to the point that they have actually been producing greater amounts of real goods and services, and there is a clear, visible improvement in Chinese citizen standards of living. All you have to do is watch some of these programs on television about China and see what's going on to see that they've got, they're pouring concrete, they're building buildings, they've got a consumer society now, and even though the agricultural rural areas are another world, they're still improving. So as screwed up as their economy is, as manipulated as it is, even though it's a bubble economy right now, what they've done at the same time is had a situation where the economy is free enough to have true, real economic growth, as in contrast to what they used to say about the Soviet Union. Keynesian economists used to say, "Oh, look at GDP at 10% a year. Their economy is growing faster than ours, even though they had no goods on the store shelves." You could look at their economy and see that it was in shambles. Shows you what GDP, that it means nothing. But
it's not honest either. It's manipulated by pretty much every country.
That's right. It means absolutely nothing in so many ways. But anyway, but you know, it's certain that China will have a bust. And the question is, what will China do about their bust? You know, in '94, when they had a bust, or 2004, you know, they apparently did the relatively right things, or at least allowed it to pump up. Well, no, they've been really growing since then. So I mean, they did something kind of right. Clearly, we're doing everything wrong. So far, I would say, you know, if I had to put my money, I would put it on China and not the U.S. for Western Europe.
Yeah, that's completely, I would say, very accurate. I actually see, you know, I agree with you. Some people say we're living the 1930s all over again, and I think there's different fates. I think America will emerge like Britain did and lose a world reserve currency, and China could become a new economic power because it still has good fundamentals. But I was wanted to ask you about the emerging market inflation. You wrote about that, and I was wondering, in the next couple of years, where do you see the emerging market consumer going? Do you think this inflation will really hurt them and it could go bust, the emerging market consumer, or do you think that it's going to be around for, you know, the next decade or so?
Well, first, let's zoom out and take a look at what's really going on in emerging markets. Similar to how we just analyzed China, we first have to kind of take money out of the picture and determine whether those countries are really having true economic growth. Because it's funny that emerging markets have been booming for years and years, and they're always emerging markets, most of them, not all of them, most of them. So a lot of that is I can't think of the word, an illusion, a monetary illusion, because they pump money in the economy, they pump up GDP, and prices rise and profit spreads rise, and people are employed, and, you know, like Argentina, but then, like Argentina, there comes a bust, and you find out, well, the whole decade's gone by, they really didn't produce anything. Their standards of living are no higher. So I don't think we can look at emerging markets as a whole. Different emerging markets, countries, some are really growing and improving. We mentioned China. I think Brazil probably is. I'm not sure about Russia. I think a lot of Eastern Europe is. I'm not sure I'm going to get this right. I think Slovenia, by far. What's the one just south of Norway? Estonia. I think Estonia is, even though it's had a big economic bust. I think they've had real, true economic growth. I think Slovakia and the Czech Republic have. So, you know, the question is the consumer spending coming from a monetary perspective, where they're taking on debt and they're getting higher and higher salaries and they're spending money, or is it coming from the fact that they have real, true economic growth? They're producing real goods and services at a faster rate, which means consumers have more real wealth in their hands. They're paid more for producing that, and they can exchange that for more goods and services. And
they're creating capital formation, right? Real capital formation.
Exactly. They're creating real capital formation, because you can't demand something, you can't buy in real terms without having produced something to exchange. So just being given paper tickets to buy with without having produced something you can call that consumerism, but then when you run out of goods, you don't have much to consume anymore. So I think you would have to analyze each country individually and determine what their real economic situation is. But overall, I think emerging markets have pretty high inflation now, not relative to their historical norms, but I think most of the emerging market growth we see in terms of GDP is inflation-oriented. I think the emerging market growth in terms of asset prices is also inflation-oriented in terms of their domestic money creation driving up asset prices. And then foreign investors are investing and driving up prices. So we'd have to look at each country and determine what's really going on, which often is not very easy to do.
Kel, thank you for your insights on that. So it just means our listeners need to do more individual research. But I think the cumulative effect of your answers brings up a very interesting point here, and I wanted to ask you about it. And that is, do you think that gold and silver, based on all the different factors you talked about and how confusing that is even for professionals, for someone who's professionally, invested and traded in the markets, and a lot of other professionals, too, who have looked at these things, do you think that gold and silver are the only true safe havens based on the conditions that we've been talking about?
Are the only true safe havens? No, I don't, and I would not consider gold and silver safe havens. I know that sounds like blasphemy to some people, but, like most asset classes, gold and silver perform well or not depending on the time period. Had you bought gold and silver in the early 80s, you'd still be underwater today in real terms. Wait, I might have that. I might be conflating that with something else I'm thinking about. You might be back to even at best, probably.
Well, I think there's a lot of truth to what you just said, because they, after 1980, when Volcker did raise the interest rates, they did tend to really underperform the real inflation rate for a while.
Well, yeah, right. That's my point. They were dead throughout the 80s, throughout the 90s until 98. So they were absolutely dead, and you would have been way underwater. And you and I mentioned briefly the idea of inflation versus deflation as an effect on gold and silver. I can tell you that if there is real true monetary deflation, the price of gold will collapse. The price of silver will collapse. Like any other asset, gold or silver, stocks, real estate, bonds, I'm trying to think of something on the main street, but nothing can rise in price unless more money is chasing it, is bidding that higher. And if you have less money in the economy, let me first say, if you have less money in the economy, the price of everything will fall.
Okay.
Now, it is theoretically possible that you could say, okay, everything is terrible, we're having deflation, so I'm going to put my money in a safe haven. So money is moved away from other areas into gold and silver, driving up those prices while everything else falls. That is entirely possible. But I really don't think that it would be a deflationary safe haven. If prices are falling, I don't think people need to flock to somewhere to maintain a purchasing power. The dollar, cash, is the safest place to be in a deflationary environment because it's gaining purchasing power. It's not going away. Or maybe I could argue a foreign currency cash is even better because the currency. If you had a foreign currency, that would rise because fall because your currency is rising as the value of your dollar is increasing. But basically, cash is a great place to be. But I can just virtually guarantee you that
until the next FDR comes along and says we're just going to devalue all of our paper fiat currencies against gold and raises the gold price to $6,000 or $7,000 an ounce to create the inflation that they want.
Right.
So that's what scares. Now I know people should keep temporary cash positions, but it just scares me. Like, there's so many different factors involved, and I've spent a few years researching this, and I sleep better at night that I do have a portion of my net worth, in physical precious metals and gold and silver related stuff.
Right. I had a thought I was just about to say, and I had it, and then I lost it. I know what I was going to say. I think that, yes, it is difficult, and in this more than ever uncertain world, it's hard to know where to flock. But the real question probably overall is, will there be inflation or will there be deflation? And if you can answer that, then you kind of know, well, if there's inflation, there are many assets to choose from. If there's deflation, you probably want to own cash, and the value of everything else is going to fall.
Yeah, but the problem, Kel, with the deflation and going into cash is that in a paper fiat currency system, where there's no restrictions on the central bankers and the politicians, is that they can pretty much just keep changing the rules anytime they want, right? And they could devalue the paper against something else so people don't get the purchasing power benefits from the deflation.
Well, I would have to think about that. I'm not saying you're wrong in any way. I'm saying I don't know without thinking about it. Certainly when there's inflation, the currency can be manipulated to fall. When there's deflation, can the currency be manipulated to rise? I think that would be sorry, I meant it can be manipulated to stay artificially high when there's inflation. But can you
Well, the only time historically in the financial world in the last 150 years I've seen any examples of this was when FDR, when he did his bank holiday and then he revalued the gold price, because there was, deflation then. And the Keynesians that were advising FDR after he ran on his, gold standard platform, free enterprise, deregulate stuff, and then he switched, and the people that advised him told him to we can't create the inflation we want any other way. Every other country is devaluing their currencies. We're going to just devalue our currency against gold.
All right, so they devalued against gold even though there was inflation, is what you're saying, right?
Even though there was deflation.
There was
deflation.
Yeah,
deflation in the U.S., but relative to all the other paper fiat currencies of the world, there was a competitive devaluation. But since the U.S. had a strong fundamental economy, for the most part, except for some of the tariffs, their economy was, strengthening, and the dollar was strengthening too much. And then, the Keynesians didn't want that, and they said, well, we'll just because we can't devalue against other paper, we'll devalue against gold.
Yeah, well, so I hear you. I'd have to fully grasp that. I'd have to look at the trends that had taken place at the time, and it seems like I should know this off the top of my head, but I don't. But usually when a currency is devalued, it's because it needs to be. I'd have to think about that. Devaluing a currency, or no, you're saying they would revalue it higher.
Yeah, what it was
revalued gold higher, but they devalued the dollar against gold.
Yeah, what it was is we were on a gold standard.
Yeah, because paper fiat currencies are really only valuable really relative to each other.
Right. So, but if they devalued the dollar against gold, that means the dollar was probably overvalued because they had been inflating. So even though maybe deflation was taking place, the dollar was still overvalued at any level, but while it's being deflated, and they had to lower it. Oh, and now, but let me think. Probably every other country was, well.
My understanding was we were on a gold standard, and I could be wrong, but we didn't have enough gold to back the amount of currency he wanted in the system. So he did a confiscation of gold, and he revalued the dollar from $20 an ounce to $35 an ounce of gold. So that was my understanding. You all can correct me now.
Yeah, and Kel is right. That was actually, in terms of purchasing power parity, I think that was one of the strongest times in the history of the dollar, because so many other European economies, Western European economies, were collapsing. and their bonds were collapsing due to, all the war debts from the First World War and then their depressions after that,
Right.
that so much money flowed back into the dollar, and, it was the dollar was way too strong.
Right.
So,
yeah, I remember studying this previously, but I think I've really forgotten exactly what went down. So you've inspired me to go back and re-grasp that. So anyway, very very good point. But your overall point was, yes, you're always at risk that the politicians will screw you over one way or another, no matter what's going on, and that is a very true statement.
That's what governments do best.
Yeah, exactly, Kel. And with physical gold, like, at least there's no counterparty risk, and I feel like the mainstream economists and the people on Wall Street, they all want cheap money, they want free money, they want more money speculated with at 0% interest rates, and that means more paper fiat money inflation, creating more money supply.
Well, and that's the real lesson. We've talked about hypotheticals here, but I would say you don't need to worry about deflation. Unfortunately, I would love to have deflation. You don't have to worry about deflation because we're not going to have it. They can prevent it now, and let me qualify that by saying, as long as people have faith in the FDIC and have no reason to start going and taking their money from banks again, and there was no indication of that in 2008, by the way. Well, I don't think there was, even though I did. The point is, there's not going to be deflation as long as people don't take their money out of banks. The Fed can fully prevent deflation, and it's never happened since the FDIC came along, and it won't happen again. Even though I had an investment guy argue with me one time that, well, there was deflation of like 0.5% in 1 year in the 1950s. But even that's not really deflation. So the point is, I think your only concern is inflation. That's the only thing we'll be facing.
Yeah, and I think, Kel, a lot of these statistics that are coming out, I think the Fed is trying to create temporary amounts of, controlled disinflation periods where they let the economy and commodity prices and stuff cool off after they do each stimulus round. So I think we're trying to get controlled amounts of inflation for a certain amount of period with stimulus programs, followed by a controlled period of like disinflation here, so the Fed can justify saying, commodity prices didn't rise after quantitative easing too, now we can do another stimulus program.
Yeah, perhaps, but either way, they're always going to keep inflating.
Yeah, and that brings us back to my point here. I just feel safer, having a certain portion of my assets in physical gold and silver because, at least they're going to retain some of their value as compared to some other investments or assets. And, I don't have to worry about them inflating the amount of physical gold or silver.
Well, that is true. However, I would also caution that just as there were bubbles in the NASDAQ and housing and so forth, there could be a bubble in gold at some point also. And by the way, let me point out that all these years everyone's been saying there's a bubble in gold. There has not been. Only now could it possibly be construed as a possibly in bubble stage. But the point is, even that safe haven gold, even though it's a risk-oriented asset, even though it's real money, people can overinvest in it and disproportionately bid it up way over its, quote, fundamentals and then flee from it for whatever reason. So you can, I wouldn't say always buy gold at any price. I would say be very careful and buy it after it's had its little retracement from the previous run-up.
Yeah, I completely agree, Kel. I think eventually we're going to get to a Phase 3 mania blow-off top stage in gold, but we're nowhere near those levels yet.
Yeah, I also agree, too. It's the one example of gold really losing value, I think, is when the New World was discovered and all this gold came from the U.S. and was shipped back to Britain. So much gold flooded into the market, it really lost value. I think that's how the bubble will end. I don't see anything like that coming yet. I think you'll see, in a bubble, you'll see massive mine expansions. And that's how I see it playing out, and I haven't seen anything like that come as of yet.
Well, that could do it. Of course, it's hard to think about how you could have mine expansions at such a rapid pace because even now with, well, let's just say I think gold is much harder to dig out of the ground than oil. So now with high prices of oil, as we mentioned, oil is really kind of flowing out everywhere. But I think it's much more difficult to get at gold in the ground, and you could only do it at a certain rate. But I'm no gold expert.
Yeah, that's a great point, Kel. And I think mining gold is a lot harder than Ben Bernanke going on his Federal Reserve keyboard and sending over a couple trillion to the ECB.
That's right. And now, after I warned that be careful, gold could fall, let me also say there's a great article on Mises.org by Thorsten Polleit, Polleit, from around, I think, 2006 or 7, where he shows how, though gold has had such a rise, even at that time it had a nice rise, if you look at the real price of gold, not in terms of the CPI, but if you think about real inflation in terms of M2 or M3 he used, if you deflate it with M2, then in real terms, gold is still way below where it was in 1980, and it would take a gold price of something like $4,000 or $5,000 an ounce to reach back where we were in 1980. So in that sense, gold is still way undervalued.
Yeah, and that was one of the signals at the end of the gold bull market, besides Volcker raising the interest rates, is that the price of gold, physical gold, multiplied by the U.S. gold reserves, actually covered more than the base money supply the U.S. government had created then. So, like you said, we're nowhere near those levels. I've heard some experts say, actually, that to cover some of the base money supply would have to go well over $6,000 an ounce. I forget which base money supply figure. But I wanted to wrap things up here, Kel. I want you to tell our listeners about your book because I think they'd be very interested in it. Give them a little summary about your book and where they can buy it, and then we'll wrap up the interview.
Oh, that's very nice. Thank you. Well, the book, which again is the case for legalizing capitalism, is really just that. It is actually written for the other side, written for our leftist friends, to explain exactly what capitalism is, how it is that we have no such thing as capitalism. We have merely partial free markets, and that what a different world it would be that we lived in if we actually did have capitalism and free markets, and how that would play out. And, for example, how it would be that we would have full employment, how it would be that there would not be a need for social safety nets, and why there would not be a need for health care insurance. Well, there would for catastrophic insurance. But the point is, the current problems we have are caused by lack of free markets, and those problems would be solved with free markets. And also I explained, for example, how companies could not take advantage of us then. They can through regulation, but they could not underpay us or overcharge us if there was competition and if there were free markets. So that is what the book's about, and it addresses virtually every political, economic topic that people discuss and that goes on at each election period, and kind of explains how the world really works in layman's terms from a economic perspective. So, and it can be bought at, the Mises Institute is the publisher, so it can be bought at the Mises Institute and or on Amazon.com. So.
All right, that sounds great, and I agree with you completely. I always say we have some elements of capitalism, but we don't have full capitalism. And I use healthcare. We have high quality, but we don't have the low cost that a free market would bring. So, and if people wanted to read more about your work, where can they find it, your articles? And thank you for your time. So.
Yeah, thanks. Well, yeah, besides my book, my articles are found on Mises.org, Mises.org. have a handful there, and that's the extent of my work because I actually do have a real full-time job, so I don't have that much time. When they appear, that's where they will appear. And yes, thank you for your time. Really enjoyed talking to you guys, and it's been a pleasure.